Hi, thank you for joining us. Look, you don't need a webinar to know that we are in a time of incredible uncertainty for our country, both in terms of health, the economy, and the markets. But I do want to challenge you on today's webinar to look at this national time of pause as a bit of an opportunity. You know, right now, more of us are home, either working from home or doing social distancing from home. And we can use this time of national pause one of two ways. We can either use it to panic about the future, or we can use it to take stock and prepare for the future. And on today's webinar, I think the reason you've joined us is because you'd like to use it to take stock and better position yourself and your retirement assets for what to do as we come out of the COVID-19 pandemic. So I'm Becky Swansburg, and my background and my original career was actually not in finance, but in government and policies. I worked in Washington, D.C. for many years, first in the White House under George W. Bush's first administration, and then on Capitol Hill for a variety of congressmen and the Speaker of the House. And through my work in Washington, I became extremely interested in the way our federal policies impact everyday Americans, and particularly American savers. And to that end, I got very interested in tax policy, savings policy, and how the decisions in Washington and the decisions of our legislators impact the decisions that each of us make in our daily lives as we prepare for the future. Now, you'll probably notice I am not on this webinar alone. I'm here with Martin Ruby, who is, among other things, an actuary. Now, for those of you that don't know what an actuary is essentially the uber math geniuses of the financial and insurance industries. And it's an actuary's job to identify and manage risk. So you can see why having an actuary on today's call is so valuable. Marty has spent his entire career as a CEO leading financial and insurance companies, and as an advisor talking about how you manage risk. Now, in addition to all of those accolades, Marty is also my father. And I want to tell you quickly how we came together to do what we're doing here today. Because my father and I have actually been studying a lot of the trends coming out of the COVID-19 pandemic well before these risks showed up with this pandemic. Several years ago, when I was home from Washington, D.C., I was talking to my father about retirement. My mother is a retired college professor, and my father's still very much working. And I was asking them how they were feeling as retirement kind of was coming up onto the horizon. And my dad said, you know what, Becky, I'm really frustrated. Now, I knew my parents had done a very good job saving. They had had good careers and had good retirement assets. So I probed a little bit and said, Dad, what's making you so frustrated? And I don't know if you remember this, Marty, but he said, the problem is now that my friends are starting to retire, that we're starting to access our IRAs and 401ks, I realize we have built a gigantic tax burden inside of these accounts. And I don't know if you remember telling me this. You said, I feel like, and I loved this line, I feel like my IRA has a silent partner, and that silent partner is the IRS. And suddenly the IRS is going to take a big portion of what I've saved. So I asked my dad out of curiosity, about how much do you think you're going to owe the IRS? And he said, that's why I'm so frustrated. I don't know, and there's no way for me to really find out. And that's what set us on this journey. So using my legislative background and policy background and my father's actuarial and math analysis skills, we started to create models that could evaluate for my parents the kinds of taxes they might pay in retirement from their current accounts. Now, we'll tell you a little bit later on today's webinar how you can actually use these models to evaluate how many taxes you might owe in retirement. But for right now, what it's important to know is that we came together and really analyzed for my parents the kinds of taxes and the kinds of income streams that they might generate. Now, once we had done that, we realized that a lot of my uncles and my parents' friends, they kind of wanted that done for them as well. And we realized that we had a message that deserved a much broader audience. So we came together and wrote 2 books. This most recent of which you see on the screen is the No Compromise Retirement Plan. And it really looks at the compromises that savers like you are making in your retirement accounts and what to do about them for the future. So what I'd like to do now is turn it over to Marty. We have been spent the past 2 years traveling all across the country until COVID-19 has kind of kept us now in the office, but traveling across the country, talking to savers like you about these compromises and about the risks that they face and need to address to be well prepared for what the future brings. So I'm going to let Marty share his actuarial insights into what's going on right now in the market, what unique challenges and risks you need to be prepared for, and what the long-term solution is going to be as you position yourself to come out of this pandemic well positioned for the future. So Marty?
Becky, thank you, and welcome everyone. When we wrote this book, it was directed specifically at the fact that most people, most baby boomers, that's kind of what this No Compromise Retirement Plan book is aimed at. Most of these people, most of us, have saved through what we call tax-deferred savings. Things like 401ks, IRAs, basically plans where you put money in, you get a tax deduction when you put the money in. You don't save tax, you defer tax. And then the money grows, and in retirement, when you start taking that money down, you pay tax on both what you put in and all that growth. That's tax-deferred saving. And for most people, that's the bulk of their retirement savings are in these tax-deferred accounts. Now, what none of us, I think, realized is that because of how we save through these tax-deferred accounts, it's forced us to make compromises. And that's what this book is about, is the compromises we're forced to make because of how we save through these tax-deferred accounts. Now, today, I want to talk about two of the major compromises. Later on, you'll learn how to get a complimentary copy of this book, and we go into more detail about these. But let's just cover two of these compromises today. One I'll talk about in a little while, Becky and I both, are taxes. But the first one I want to concentrate on is the one that's kind of obvious out there today, and that is the compromise we make between growing our money. As we're saving money, we know we have to get it to grow, and usually that means you got to be in the stock market. But that means you got to take on a lot of risk. However, as you get nearer retirement and in retirement, you got to start taking that risk off the table. We can't afford another large drop like we've recently had, and you don't have time to make it up. So what does that mean? You get into safer instruments. Maybe it's a CD, maybe it's annuities, maybe it's high-grade corporate bonds, or what have you. But here's a problem. Interest rates are at record lows. So if you want protection, you want that safety, you got to give up the yield. So this compromise we're going to talk about is, do you go for growth but risk, or protection but lose all the yield? So let's start with the growth part. And I want to bring up a slide here. And this slide is, this slide shows the S&P 500 index total return with dividends between 2000 and 2019. And this is the close of market as of the end of last year. So it's a 20-year measure of the market. And for most people, most professional money managers, when you say, well, how'd you do this year? This is what they compare it to. The index of the 500 largest companies, publicly traded companies in the United States. And the reason why we picked this particular period is up until recently, we thought, well, this is pretty representative. We have two big bear markets, the dot-com bubble burst of 2000 and 2002, and the financial meltdown of 2008, and two bull markets. In fact, as of the end of last year, we were in a historic bull market. It was the longest bull market in U.S. history. And so the first thing I want to point out to people is, after 20 years being at the all-time record high at the end of last year, the market did only return about 606. In other words, only about 6% over that 20-year period. For a lot of people, that's less than they would have thought. They've always heard, well, the market is double digit and this and that. But the fact is, that's the numbers as of the end of last year. But here's a problem. If, like most of you, I know I've saved in tax-deferred accounts, that 6.06 doesn't all belong to us. A portion of it belongs to the IRS. You've got to pay tax on that return. Now, for purpose of what I'm going to talk about today, I'm going to use an average 25% state and federal tax rate. For some of you, it may be higher, some of you may be lower, but let's use that as an average. That means that a quarter of that 6.06 belongs to the IRS. So in reality, we've only really are only going to earn about 4.5% over these last 20 years after taxes. But there's more than that. If you're in a 401k, an IRA, or any kind of financial instrument, there are expenses. Everybody charges expenses, whether they're hidden within the product itself or explicit, there are expenses. They could range from 0.5%, 1.5%. It varies all over the lot. But here's my point. If, like most people, you've relied on the stock market to grow your money over time, after taxes and after fees, probably in your tax-deferred account, you've been lucky to get 4%. Not horrible, but certainly not kind of what you'd expect. But now let's update this slide a little bit, because even though we see the impact on taxes on this return, obviously there's an impact on expenses. Finally, after 11 years of a bull market, we're now seeing what is the impact of a downturn in the market on this. So I want to show you another slide. We ran these numbers out just for another 2.5 months. So we went from the end of 2019, which you see here, now to the March 16th of 2020. In 2.5 months, the market gave up almost 24% from its high where it was at the end of last year. And that average return over the entire 20 years, or now 20 years and 2.5 months, went from 606 on average every year to 442. In other words, one bad market period, rather intense, rather concentrated, dropped that return by a quarter. It is kind of incredible how much that 20-year return has been impacted just by that short period of time. So my point here is, I think the last several weeks in the market has shown there's a huge risk to keeping money just simply exposed to the stock market, pure and raw. And as I said, as you get older now, you got to say, well, I can't take on that kind of risk. Now, I don't know if you remember, but our parents, the way they saved money for retirement when they were in retirement is a lot of them would just put money into CDs. They put money in what's called a laddered CD structure, 2, 3, 4, 5-year CDs. Every year they'd roll them over and they'd collect their 4 to 6% interest. And it was relatively easy and relatively simple to do that. Well, we know today that that is a changed market. We can't do that anymore. Interest rates are at historic lows. Now, this is something else that this coronavirus kind of crisis we're in has changed. It used to be that we were in a market where we thought at some point after 2008, where rates did come down, where the Federal Reserve Board and all the central banks in the world slammed rates to zero in order to kind of nurse back the health of our financial institutions. And most people thought at that time, well, a couple of years later, we'll kind of be back to historic levels of interest rates. That didn't happen. For 11 years, the Fed kept rates very, very low. We thought there was a couple years ago, when they might be coming up a little bit, then they came back down. And now what's happened? Now we see rates even lower. In fact, Treasury bills at one point got to a negative yield, which means that you were paying the Treasury for the privilege of holding their securities. So I think that people are starting to realize that this kind of era of low interest rates may be with us, possibly for the rest of our lives. It's hard to see with the deficits and the way they're growing today and all the other turmoil that's going on. It's hard to see, if we couldn't get the rates up in 11 years since the financial crisis of 2008, why they would all of a sudden come up soon. And so what we have is what we talk in the book about a saver's dilemma. And this is something that we as a kind of retiree generation are going to have to grapple with, probably, I think, for the rest of our lives. And that dilemma is as follows. On the one hand, you want to have the growth, and that means being in the stock market. But that is very risky. On the other hand, as you get into retirement, you've got to take that risk off the table. And what that means is you're into instruments that have practically no return, no yield to them. So we're all faced with this saver's dilemma. What do we do? How do we generate not just some gain from our portfolios, but also some actual income that we could spend in our retirement years. Now, we're going to talk in a little later about a couple different ways. There are ways to do this. And one of the good things that I think is the advantage of people working with retirement advisors like we are today is that they have some solutions. We're going to talk about a couple later on, but there's no question that you are limited. If you want to deal with this saver's dilemma, your limit is what you can do. And you got to think very hard about what are your choices and optimize and make sure your portfolio is kind of taking advantage of those choices. So that's the saver's dilemma. Now, we know that is one aspect of what's going on. It's kind of the obvious aspect because of the coronavirus, the whole COVID-19 crisis going on. We've seen turmoil in the financial markets. Stocks have gotten very volatile, interest rates extremely low. However, I believe there is an ongoing, long-lasting effect that people aren't focused on yet, and that is the effect on taxes. And so we're going to get into that in a second. But what I want to point out is we are running multi-trillion-dollar deficits now. Before the crisis, we already were thinking about a $1.4 trillion deficit. Now, I think that with the stimulus bills passed and with the fact that in a recession, deficits tend to go up anyway, you could be looking at a $4 trillion plus deficit, and certainly levels very, very high compared to history beyond that. Now, I think as baby boomers, we understand that we've eventually got to pay for this somehow. And in fact, when I turn this over to Becky, I want to point out a quote by our Treasury Secretary, Steve Mnuchin. He said, "In different times, we'll fix the deficit. This is not the time to worry about it." Well, ladies and gentlemen, I think what we're going to show you for the remainder of this presentation, how you are going to have to think about it, because you're not just worrying about the next few months, you're worrying about the rest of your retirement life. So Becky, I'll turn it over to you.
Yeah, thank you, Marty. So I feel like the market right now is the risk you know. You turn on CNN, Fox News, everywhere talking about market, the impact it's had to savers. But taxes are really the long-term impact of COVID-19 in today's environment. Because if you think about it, we are taking on trillions of dollars of new debt at this time. And when the Treasury Secretary talks about now's not the time to worry about it, the time will come to worry about it. And when the time comes to worry about the trillions of dollars in new debt that we've assumed in the last month or so, how are we going to go ahead and worry about that? Well, the only way the government knows how, by increasing revenue, which means increasing taxes. And so I want to talk a little bit from my background about some tax policy and what we might expect in the future with taxes. Now, all of us on this call today, you, me, Marty, we've all really been trained to think about taxes in a certain way when it comes to our retirement savings. And it's really the foundation of all of tax-deferred savings. And that's the idea that while we're saving, we will be in a higher tax bracket than when we're retired. That's why 401ks, IRAs, and other tax-deferred accounts make sense. I am not paying taxes today when I'm in a higher bracket. I'm going to defer them to the future when I'm in a lower bracket. Is that true? Now, when I think about my grandparents, it was certainly true for them. My grandparents were part of the greatest generation. Both of my grandfathers fought in World War II, one in the Pacific and one in the European theater. And when they retired, what did they do? They really sucked everything in. They felt that fixedness of a fixed income. And they stopped traveling and taking vacations. They started getting, 99-cent senior coffee at White Castle. They really lived on a limited budget, and in that way, spent a lot less than they did when they were working. But now I look at my parents, and my parents, like most of the people on the call today, are baby boomers. What's their retirement going to look like? Well, I can tell you, as my parents see retirement on the future, what are they doing? They are going to every new restaurant with their friend that opens in our city. They are traveling all over the country and all over the world. Once airlines let us travel all over the world again. They recently bought a lake house up in Indiana so that their grandkids, the most important thing to any grandparents, have somewhere to go and enjoy, kayaking and hiking, and we can be together as a family. The point I'm making is that for baby boomers, sucking everything in and spending less in retirement doesn't seem to be the way they want to go. And that's because I think my grandparents' generation really saw retirement as the place you go to live carefully and wait out death. For my parents' generation, for the baby boomers, that's just not the case. Retirement for my parents is the reward that they have earned for years of hard work and hard savings. And they want to enjoy those retirement years fully. And if they want to maintain their lifestyle in retirement, what do they also have to maintain? Their income in retirement. And that's why I think that really the foundation of tax-deferred saving is starting to crumble. And it's really leading us to something that I like to refer to as the great American savings myth. And that is the myth that our tax rates are going to be significantly lower in the future than they are today. And I want to take you through a few reasons that I think both from the economy and from tax policy and tax law, that could be the case. All right. There are three real ways that we could end up paying significantly more taxes in the future than we are now. And I want to run through those quickly. The first is that your tax bracket can change. And this is really the idea behind tax-deferred savings, right? You're in a higher tax bracket while you're saving the money, you defer it and pay taxes when you're in a lower bracket. That was really based on the idea that most people do not see themselves earning more income and going into a higher bracket in retirement. That's probably true for most of the people in this call. But that doesn't mean that your tax bracket isn't going up in the future. And in fact, we know your tax bracket is going up in 2026. Why is that? Well, if you remember at the end of 2018, Congress passed and the president signed into law comprehensive tax reform, those Trump tax law. And that law reduced tax rates and tax bracket rates on millions of Americans, myself included. What's easy to forget is that those tax rate reductions were temporary. They sunset in 2025, which means that unless Congress acts to change it, all of our tax rates are going up in 2025. And if you historically look at most major tax packages going back to the Kennedy tax cuts, Congress mostly lets them expire because the political usefulness of those lower tax rates have already been used up by a past Congress, and it's time to do something new. So I think that there's a very, very good chance when the current tax bracket reductions expire in 2025, we'll all see our rates going up in 2026. Now, I've held this belief for the past couple years, just looking at our deficit spending and kind of entitlement spending in our country. March of this year doubled down my belief that tax rates are going up. Because as Marty mentioned, we have trillions of dollars of new debt with the stimulus packages that have been passed. How are we going to have to get that debt paid off? Higher taxes. So I think if at the beginning of the year you were pretty sure tax rates were going up in the future, now it feels almost guaranteed. And that's one way that you could end up paying more in taxes in the future than you do now. But it's not the only way. And I think these other two ways are ways that we're going to see taxes go up in the future because they're what I might call stealth taxes or stealth ways that taxes can go up. Because congressmen do not want to vote on tax increases for their constituents. They're happy to let tax reductions expire, but they don't want to have to vote on a raise on your taxes. So what is Congress going to have to do? Our government leaders are going to have to find new ways that you can pay more taxes without them having to vote to raise your tax brackets. The first thing is around deductions. And I think we're going to slowly see deductions be pulled back. We saw a little bit of this standardizing the deductions under the Trump tax law that was passed at the end of 2018. If previously you had $100,000 of taxable income and you could deduct $20,000, now you have $80,000 of taxable income. If instead Congress votes and you can only deduct $10,000, you now have $90,000 of taxable income. Did your tax bracket change? No. Do you end up paying more taxes? Absolutely. The third way is really new taxes that Congress can pass that they don't have to call taxes. This could be, we've seen a little bit of this. This could be anything from right now, your Social Security, up to 85% of Social Security can be subject to taxation. Well, Congress could pass tomorrow that up to 100% of Social Security income could be subject to taxation. Did they change your tax bracket? No. Do you end up paying more in taxes? Yes. These kind of self-taxes can have a trickle-down effect. If you think about your Medicare Part B premiums, which are based in part on the last several years of income, the more taxable income you have because of self-taxes, the higher your Medicare Part B premiums are. The net is there is a lot of ways that Congress can deliver less money to your pocket and more money to the IRS without ever touching your tax brackets. So I would encourage you not to only consider tax bracket rates when you think about where your taxes may be going in the future. This really is, I think, what COVID-19 has helped uncover. We're all very aware of the market risk that exists right now, but equally important to that, and you must absolutely prepare the same way you're preparing for market risk, for legislative risk and tax risk. And when you save in a tax-deferred vehicle like a 401k or IRA, all of your future taxes are subject to that legislative risk. They're subject to Congress changing the rules. It's hard to remember back to when the Secure Act passed and went into effect at the beginning of this year. But there was a great quote from a CPA that he shared when the Secure Act passed. And what he said was, our tax code when it comes to retirement is all written in pencil. And it's absurd to think that the tax code we live in today is going to be the same code for the next 30 years of your retirement. So I want to make sure that as much as we're focused on market risk, we are equally looking at that legislative and tax risk in your portfolio and your retirement assets. This really kind of speaks to the difference between what I would call a micro and macro approach to taxes. Most of us have been trained to think about retirement taxes through a micro lens. And a micro lens has a goal of reducing your taxes in a given year. And that's why we have tax-deferred saving, because I can deduct or defer taxes on a certain portion of my income this year. What I hope you will take from this webinar, and what is a passion of Marty and I, that we go and speak to audiences across the country, is that instead you take a macro approach to taxes in retirement. And the goal of a macro approach is not to reduce your taxes this year. It's to reduce your lifetime taxes in retirement. Now, you are incredibly fortunate to have an advisor in your community that understands this macro approach and understands helping clients prepare and plan for a macro view on their retirement taxes. Because there are a lot of communities where no one is helping savers like you with this macro mindset. And I think that it's one of the most important risks that the average saver is missing. Now, this is all good and grand as theory, right? You can say, thanks, I'm glad I joined this webinar, and now I know about this theory of a macro and micro approach. But how does it play out? Well, I want to take you back to the story we started this webinar with, and that's my parents and their retirement assets. And I talked that we had made some models and reports to try to analyze the taxes my parents might be paying in that macro view. And I'm going to hand it back over to Marty and let him take you through what we found out was the truth for my parents and their account. And then when Marty's done, I'll show you how you can actually use these same models and reports to analyze your potential total taxes in retirement. So Marty?
Thank you, Becky. So what I want to show you is a sample of a report. And it was really the first analysis I did. We have other ones available now through our people we work with out in the industry. But the one I want to focus on today answers a basic question. I've saved through a tax-deferred account, IRA or 401k. I've accumulated so much money. From this point forward, how much taxes will I have to pay because I saved tax-deferred? And so I actually looked for that answer on the internet, couldn't find it, and that's why we developed our own type of report. So here's what you see here. We have a 500,000. I use a 66-year-old because, quite frankly, that's how old I was a few years ago when I first thought about this. A 66-year-old with a 25% tax liability. Now, the model can assume anything you want. We've assumed 25% for now, federal and state. And again, we've assumed that taxes won't go up for this purpose of this one model. And we've assumed that the IRA will grow at 5% a year. So while you're waiting to take income out, it'll keep on growing. And so the question is, how much does this $500,000 of current value IRA generate in future taxes? And so we looked at three different taxes. One is distributions. Anytime you take money out of your IRA, a traditional IRA is going to go on your tax return. It's included as ordinary income. Now, if you go to your CPA and you ask your CPA, hey, what's a way I can minimize taxes this year, a micro view, what he or she will say is, well, don't take as little as you're required to take out of your IRA. So we're going to follow that advice. It's conventional advice. So what we're going to say is, well, I won't take anything out of my IRA. However, the IRS is something called an RMD, a required minimum distribution. And what they say is, starting at age 72, you must start taking money out of your IRA. It's called an RMD. Now, why does the IRS make you do that? They've been waiting patiently for your tax dollars all these years. Now it's time to pay up. So on the first distribution, we assume you're going to wait as long as you can, but then you're going to start taking out your RMDs, your required minimum distributions, starting at age 72. The second component of this first report we're going to show you looks at, okay, it's a savings model. So we're going to take that money out, pay the tax on it, on the RMD, and then redeposit that money in a taxable account. Because once the money's out of the IRA, you can't just put it back in. You have to now deal with the fact that it's no longer sheltered from taxes. And finally, when you die, and we assumed here in this case, the account holders will live to age 90, but when you die, whatever remaining value is in the IRA, your beneficiaries have to pay tax on. You don't get out of taxes, well, you do, but your family doesn't get out of paying taxes by you dying. Somebody's going to be taxed on that money before it can be used. Now, I want to pause for 1 second and talk about inherited IRAs, because I think there's a huge, huge tax risk in this that people have got to realize. Let's take example one. You leave money to your kids, your grandkids. Well, when you think about it, that's not a really nice legacy to leave somebody with strings attached, because now you're saying, instead of me paying taxes, now you have to pay taxes on it. And it gets even worse than that, because you got the benefit of these tax deductions while you were making contributions. But now when it comes time to pay the taxes, it's your kids and grandkids that have to pay it. And they may very well be at much higher tax rates than when you put that money in. So again, leaving an IRA to a beneficiary like that, in terms of how it looks from a legacy viewpoint and how it looks from simply the tax burden they now have to take up, not so good. But it gets much worse than that. Because generally, you have a married couple, they've been using this IRA to follow their joint expenses. And typically, when the first spouse dies, the remaining spouse inherits the IRA of the other spouse. Well, there's now something that people are calling a widow's penalty or widow's tax. And this is how it works. When you were married, when both of you were alive, you were filing most likely a joint tax return. And you got certain breaks because you were filing as a married couple. However, the year after the first death, the remaining spouse now has to file as a single taxpayer. They pay much more taxes per dollar of income. So think about the impact of this. You've left an IRA, your spouse gets it, and now on the exact same amount of money you've saved, and by the way, it doesn't matter whose IRA this came from, you or your spouse's, you now have a spouse who's looking at using this IRA and generating income, and he or she is paying a lot more taxes because they're now filing as a single taxpayer. It's called a widow's penalty. It's real. And again, it's another huge risk you take because of how you've saved and its impact by taxes. But regardless of that, we look at these three elements. And so you can see on the slide here that the first element, the RMD, taxes on RMDs, this $500,000 IRA will generate $158,000 of taxes. On the kind of reallocated money that's no longer sheltered, another $69,000 of taxes. And finally, because this IRA is continuing to grow, there's another $110,000 of taxes that are due that the beneficiaries will be paying. So in total, this example, this $500,000 IRA is going to generate in the next 24 years between age 66 and 90, $338,000 of taxes. Now, does that number surprise people? I think a better question is, does it disgust people? I know it disgusted me. I said, this is unbelievable. This number is huge. Now, your IRA will keep growing, but up until now, 2/3 of what my savings and all the effort I put into it and all the sacrifice I've made have been gone to pay the IRS. I said, there's got to be a better way. There's got to be a way to reduce that liability. So what I looked at next was saying, okay, let's think conceptually that instead of just keeping all of our money in that tax-deferred IRA and letting it run until we're no longer around, what if we did what's called a Roth conversion? What if we took that same money, get the tax that we owe today paid at today's lower rate, as Becky described, most likely a much lower tax rate than we're going to see in the future, and then let everything run tax-free? So now you see that $500,000, you convert it, you get rid of that 25% tax liability. It's 125. And from then on, both the money you take out of that Roth and the money that your heirs get, it's all tax-free. So you've reduced that $338,000 risk that could probably be higher if tax rates go up in the future to a known $125,000. It's called a Roth conversion. It's one way that you can actually kind of save literally hundreds of thousands of dollars of taxes and eliminate that tax risk going forward. However, I'm an actuary, and I've been around this stuff literally for 48 years now. And I said, there are other parts of the code that I could save under that actually might have advantages over a Roth. And so let me tell you a little bit about what I did for my own IRA. This is my own thinking, but I think it's going to probably apply in a lot of other cases too. I show a picture now of Title 26 of the U.S. Tax Code. This is how you and I are taxed today. It's the law. And for example, if you go to Section 401k of Title 26 of the Tax Code, that's in fact where 401k plans get their name from. It's in Section 401k of the code. And it simply says, if you're going to save in a 401k plan, you are ruled by the taxes, restrictions, rules as embedded in Section 401k of the code. If you're in an IRA, you're Section 408. If you're a school teacher, you're in 403b. If you're a public employee, you might be in 457. Here's the point. The 400 section of the code is how most people save today, and it's that tax-deferred part of the code. However, there's no law that says you have to save under the 400 section. So what I know that I've done with my own money that made a lot of sense to me is that I looked at a different part of the code. I looked at Section 7702. Now you might say, well, he's getting kind of geeky here. What's Section 7702? I will tell you what it is, and I will tell you, as running the numbers, at least for me, it made a huge difference. 7702 is the tax law that covers life insurance. Now, I'm not talking about any kind of life insurance. I'm talking about specifically a product that I've used to my advantage that is called Index Universal Life. It's an accumulation type product. Like an IRA, it's designed to derive income from while you're alive. However, because you're under Section 7702, similar to a Roth, once you're in, there's no more taxes. Either the money you received during your lifetime or the money left as a legacy to your heirs. There are also some other benefits to Index Universal Life. We go through in a lot more detail in the book, but just let me tell you that it does answer this saver's dilemma because it protects you when the market goes down. It provides a true legacy value for your heirs over and above the money you've been spending down in your account during retirement, and it provides long-term care benefits. So anyhow, I just want to kind of let people know there are alternatives out there. When you sit down with your retirement advisor, they'll go through all of this. But I just want you to keep an open mind, because I think you'll see that there are ways to take advantage of other parts of the code that are not necessarily in the 400 section. So what I want to do now is really hand this back to Becky, but really, because we're about almost done now, but I really want to stress to people that if you're a baby boomer, you are at a decision point today. You can decide, in the case of the example I gave, to just stay where you are today, do nothing, keep your money in your IRA, your 401k, and let it go for the rest of your life, and kind of resign yourself to paying that, in my example, $338,000 in taxes. And again, no protection against rising tax rates. Or you could take some action today. Limit that tax cost to $125,000. Remember, you already owe taxes. It's just a question of when you pay them, and get away from all this tax risk. So with that, Becky, I'll give it back to you to close up.
So you've probably noticed we are big believers in tax diversification. Big believers in tax diversification. And when I looked at my parents' kind of outcome of these models, here's what hit me. If you have saved in a 401k or IRA, there is a mandatory minimum amount of taxes you owe. If you cash that account out today, you owe the IRS taxes. And if anyone tells you that they can get you out of owing the IRS your mandatory taxes, you should run, because they're not telling the truth. In my parents' case, it was $125,000 that they owed just based on the way they had saved. But when we ran this report, I saw that my parents were projected to pay $338,000 in taxes, which says to me they have $200,000 of optional taxes that they're going to pay based on the way they save if they've refused to diversify. And each and every one of you in your retirement accounts today have a mandatory tax that you owe to the IRS, and you likely have optional taxes based on the way you've chosen to pay that you're being projected to owe. So what I want to leave you with on today's call is that you have to understand your optional taxes. You cannot be and make informed decisions about taxes in retirement if you don't have information. And that's why it is so important to book a call with your advisor and start to understand the optional taxes that you may be projecting to pay in your retirement account right now. So here's what we're going to leave you with. One, we will get you a complimentary copy of our book. This has been a briefer call, but we'll let you see the entire story and how it unfolds. But two, if there is one thing I urge you to do, going back to how we started this webinar, we are in a time of national pause. You can use that pause to panic about the future, or you can use that pause to prepare for the future. The best thing you can do to prepare is analyze those taxes in your retirement strategy and decide, if you have optional taxes, what you want to do about them. So you see a link on your screen right now. Click that link, schedule a brief call with your advisor. They'll go into everything that you need to know about that macro approach to taxes. Now, I want to tell you, there are very few select advisors across the country that Marty and I work with to give access to these models and these reports. I get asked a lot, why is it only a select few? And the answer is there are not that many advisors in our country that truly understand the macro importance of tax diversification. Do not waste the opportunity that you have an advisor like that in your community. Book your call, get a copy of the book, understand your taxes and how market is going to impact your income, and be better prepared for the future. Now, I mentioned my greatest desire for you is for you to make informed decisions, and to do that, you need information. So I want to leave you with one of my very favorite quotes. If you've ever heard of Judge Learned Hand, he's a district court judge and is one of the most quoted judges from the U.S. Supreme Court. And he has a great quote that I think speaks directly to where we are today in the COVID-19 pandemic. And he said there are two systems of taxation in our country, one for the informed and one for the uninformed. Please use this time of national pause to be informed, to be prepared, and to position yourself for success of what comes next. Thank you so much for joining us. Be sure to book your call with your advisor. Have a great day.